to the Marrakesh Economic Festival, a conference jointly organized by the Policy Center for the New South and the Reinventing Bretton Woods Committee. We are honored to begin the conference with opening remarks by Karim Al-Ainaoui, Executive President of the Policy Center for the New South, and Marc Cuzan, Executive President of the Reinventing Bretton Woods Committee. Karim Al-Ainaoui, the floor is yours.
Thank you, Voice of God. Welcome. Welcome all of you to this economic festival. It's a pleasure to have you here in Marrakesh in the broader context of the annual meetings that are organized here in Morocco. Thanks to you, Marc. Also, thank you very much for your friendship, your partnership, your commitment to the New South, your commitment also to dialogue and exchanges in an open and tolerant spirit, which is what unites us. And this is also one of the central value of the Policy Center for the New South. We corner this term 10 years ago, and we give it the name of an institution, the Policy Center for the New South, which is today a team of 110 people, close to 70 researchers, producing 200 pieces a year, with over 1 million of unique visitors on its website. And so we're very proud to have you embark on what we do, and for you also to feel the flavor of the New South. I think it's a period of entanglements between economics, politics, domestic politics for many countries, divided internal fronts, polarized political spheres, complex regional geopolitics for many countries, and of course broader challenges at the global level with fragmentations and what we could call disorder. I'm not going to go into much details because we're having many interesting discussions, but what is important is maybe just to give you not an advice, but something that we believe is important is to listen to each other, North and South. And I'll explain a little bit later what is the New South precisely, because we cornered this concept and we have elaborated it, and it makes more sense today between the global South, I would say, and the North. There is a way in between that Morocco epitomizes well. And it's something difficult to describe, but it's something that you can feel if you take the time to look closely. It's of course a bit far away from macroeconomic policy. Myself, I'm a former chief economist of Morocco Central Bank, and I spent 10 years at the World Bank, so I've participated to 18 annual meetings, and also as an alternate from time to time representing the governor at the World Bank, at the annual meetings. But I see today that all this is closely linked, and that is even in the financial community, we have a broader responsibility of the general order of the world, its march, and the connections that we need to establish with each other so as to build a better future for our children, but in our case also for Africa in general. And the Policy Center for the New South, we've been heavily involved in contributing to the reform of multilateral development banks, and particularly development finance. We've been working very closely with the Center for Global Development, with Masoud. I don't see him, but we have another event running in parallel. He must be around. And so, Marc, thank you again, really, for your energy, for bringing this community to us. And I think, as I try to describe, it goes beyond just running events. We have something inside that drives us, There's a nice word in Arabic. It's called niya. It's called breath. That drives what we're trying to do here. And you will feel it also in Marrakesh, a city that is at the crossroad of sub-Saharan Africa, the Mediterranean, the East, and of course, very close by Europe. So many thanks for taking the time, for coming and joining, and we look forward to have discussions, engage with you. This is going to be, we're going to be here until Sunday, so we have not much to do. We are here. Take the time, it's worth it, really. Many of our problems today are because people are not knowing each other, are not taking the time to understand and to put their feet in others' shoes. And I say this also, I'm a dean so I have students, I teach, and I'm dean at the Faculty of Economic, Social Sciences and Behavioral Social Sciences in Rabat, and that I can see the bridges between young kids that come at 18 years old, 70% women here in Morocco at the university, and I can sort of liaise all that, and I see also we have more than 10% of our students coming from all around the world, and particularly from Europe. And you can be optimist when you see those kids at the university. So this is also part, I would say, of what we try to do at the between generations and also between geographies. That's the mission of the Policy Center for the New South. So many thanks again. Thanks to the team for putting all this together, and particularly to you for having decided to spend some time with us here. Thank you.
Okay, good morning, everyone. Welcome. This is really a great pleasure to be here in Marrakesh. And first, at the outset, I really want to thank the Policy Center for the New South, Karim, his leadership, but also all his team, who have been committed since May, in fact, to put together this Marrakesh Economic Festival. We call it festival because, unfortunately, the state of the world is quite gloomy, so we wanted to provide a little atmosphere that, not to create joy, but at least that all of us here, as Karim said, can meet, interact, and can discuss so many issues that we put on the table. We have a very rich program that we start today with the issue of macroeconomic policies, monetary policy, 2 issues about de-risking, 2 issues of the prospect for emerging markets, and tomorrow and the next few days related to the issue of payment innovation and central bank digital currencies, the new frontier of money, but also all the consequences and the concerns we have related to sovereign debt distress in many developing countries. So we were trying really to think about the topics that are going to be at the core of the discussions among policymakers here who are planning to attend the IMF and the World Bank meeting in Marrakesh. So the goal was bringing together not only the advanced countries, but also what people call now the global south. I will call it, very inclusive. It's not a divide between the north and south, but at least that we need to recognize, that growth prospect will be driven more and more by the south. And number 2, that we need also to bring on the table their perspective and their vision. So you can clearly see this time we were able to bring many central bank governors from Tanzania, Mozambique, Sri Lanka, Morocco, and others, really to engage with many countries around the world. I didn't count how many countries will be participating and speaking at the event, but I think there are quite many. This event used to be generally held in Washington during the IMF and World Bank meeting. So this time is in Marrakesh, so that's why you have a spirit also, I think, that we want to convey. That's why we call it the Marrakesh Economic Festival. And I want to really thank also all our speakers who have accepted to join, and also all of you coming from other part of the world and accepting to participate for the event. We will start, I think we have a very strong panel today to set the stage about the current global macroeconomic context. We left maybe 3-4 years ago where we were thinking about a world that's going to be driven by low interest rate, low inflation, and now we all talk about higher for longer, higher interest rates, and higher inflation. So I think we all know, and as we have a lot of investors, market participants, to really understand, are we heading toward the new macro paradigm, what are going to be the consequences for financial stabilities and for super growth. I think we have a very strong panel who will be able to discuss these topics. I know this is something that is at the core of your interest, but also maybe medium-term and long-term topics like climate finance and finance for development. There will be the big discussions with Professor Stiglitz, Masoud Ahmed, and many policymakers. So my message to you, this is a festival, so you are welcome to come in, to come out, but hopefully to be able to participate, we engage also take the time to ask questions to our speakers. And I reiterate really my strong thanks to Karim, his leadership, and all the team who have been dedicated for the last few months to put this event together. And we all welcome you to Marrakesh, and we hope that the takeaways that we can maybe all together thinking about some interesting insight and some maybe a way forward, not for the global financial architecture and for the global economy. And thank you very much. Thank you.
Ladies and gentlemen, please remain seated. We will now begin the second session of today's event, a high-level conversation. This session is jointly organized by the Policy Center for the New South, the Reinventing Bretton Woods Committee, and UBS. Please welcome to the stage the moderator for this session, Aaron Kapteyn, Global Chief Economist at UBS. And the speakers for this session, Michelle Bowman, Governor of the Board of Governors at the Federal Reserve System. And Klaas Knot, Governor of the Netherlands Bank and Chair of the Financial Stability Board. Aaron Kapteyn, the floor is yours.
Good morning, everyone. So I've already been introduced. I'm Aaron Kapteyn. I'm Chief Economist of UBS Investment Bank. The speakers don't really need an introduction, and they sort of just got one, but just very briefly, Michelle Bowman to my left, she's been a member of the Federal Reserve Board since 2018. She was a Kansas State Bank Commissioner in 2017 and 18, and she was a Vice President of Farmers and Directors Bank in Kansas before that. She's also held positions at the Senate, and she's been a Deputy Assistant Secretary in Homeland Security. And then to her left is Klaas Knot. He's been president of the Nederlandse Bank since 2011. He's also chair of the Financial Stability Board since late 2021. He, of course, is a member of the ECB Governing Council and also sits on the European Systemic Risk Board. So the plan is that Michelle is going to start us off by giving some opening remarks. Then we'll actually have Klaas give his opening remarks, and then we'll do Q&A. I have a few questions I want to ask, but then we'll try to also save some time for the audience. So, Michelle, the floor is yours.
Well, thank you very much, Aaron. It's a pleasure to be here with you today to discuss the role of central banks and financial regulators in effectively promoting a stable and resilient financial system. Before I begin my remarks, let me first take a moment to express my deepest sympathies to those who have been impacted by last month's earthquake. I would especially like to recognize the Moroccan authorities for their efforts to host this important gathering under such challenging circumstances. We're grateful for your determination and inspired by your resilience and your hospitality. But today, I will discuss several financial system vulnerabilities and risks that I see as most salient. I'll then offer my thoughts on how the Federal Reserve and other financial regulators and central banks may be able to address and mitigate these financial system vulnerabilities and risks so that monetary policymakers are able to continue to pursue their monetary policy mandates. In the interest of time for our conversation this morning, the full text of my remarks are published on the Federal Reserve's website. But this discussion is based on those published remarks, but they're limited to conform with our panel's time constraints. The recent macroeconomic experience has presented central banks with both monetary policy and financial stability challenges. In many economies during the pandemic, supply chain disruptions, coupled with strong demand, acted as catalysts, pushing up inflation to very high levels. as economies emerged from pandemic restrictions. Aggregate demand was also supported by accommodative monetary and fiscal policies, which served to bolster the balance sheets of households, businesses, and local governments. It increased excess savings and contributed to very tight labor markets. Many central banks facing these dynamics have tightened monetary policy in an effort to bring demand and supply into better balance and to bring inflation back down to their targets. As they've confronted price stability challenges, central banks have also faced new financial stability risks, with some related to the sizable moves in interest rates in an environment with persistent elevated inflation. The recent experience has also highlighted how geopolitical tensions can pose financial stability risks through greater financial market volatility or through their possible effects on economic activity and inflation. Like many other central banks, the Federal Reserve continually monitors a wide range of emerging risks and vulnerabilities in the financial system. We need to be responsive to changing conditions in our assessment of and response to financial stability risks. Starting with the banking sector, the events of earlier this year underscored the strength and resilience of the U.S. banking system. The vast majority of U.S. banks are adequately managing their interest rate and credit risk, and they're maintaining prudent capital and liquidity positions. While the banking sector is expected to experience higher funding costs and some deposit outflows as a result of tighter monetary policy and higher interest rates, these outcomes can create vulnerabilities. Banks relying on more expensive deposits and that also have large holdings of long-term assets like longer-dated securities, loans, or securities with low fixed rates will likely experience a drag on earnings should interest rates stay higher for longer. Rising interest rates may also erode the credit quality of bank loan portfolios if economic activity and income soften, posing an additional source of risk to bank earnings and capital. It's important to monitor these evolving risks and take action to minimize spillover effects into the wider banking and financial system. The Federal Reserve's recent stress test of the largest banks featured a scenario with extreme declines in asset valuations and a steep rise in unemployment. All of our banks subject to this test passed. Earlier this year, we saw a run on the deposits of Silicon Valley Bank and other related banking sector stresses, which highlighted banking system vulnerability to an erosion of confidence. This erosion of confidence, even when it starts at a single institution with its own unique and isolated issues, can pose risks to a larger set of institutions based on similarities in size, business model, or customer base. As in the past, an erosion of confidence can lead to sudden, large deposit outflows. Today, social media and technology can certainly accelerate the spread of fear among depositors and bank investors, exacerbating contagion risk. Another concern relates to the potential decline in commercial real estate values, resulting in a degradation of CRE loan quality in certain markets. Low return to office rates and a current trend of businesses opting to reduce office footprints may lead to higher vacancy rates, putting downward pressure on property values in certain sectors and locations, including in city centers and retail properties. As the economy slows further, CRE loan quality could deteriorate as interest rates stay high or property values soften. But while many banks are well positioned to work with their borrowers to restructure loans or to mitigate risks of losses, some banks with large, undiversified, and geographically concentrated CRE portfolios may be at greater risk. There may also be potential financial stability implications of non-performing CRE loans packaged as a part of commercial mortgage-backed securities, or CMBS. Pooled CMBS investments are often held in significant volumes or in concentrated shares by large insurance companies and pension plans. Should we see significant losses in their CMBS holdings, there could be broader effects on the securitization pipeline for CMBS and on the CRE market. But turning to non-bank financial conditions, I'm also closely watching other financial stability vulnerabilities that are posed by large bank financial institutions. Hedge fund leverage remains elevated, and prime money market funds, insurance companies, and some corporate bond mutual funds remain vulnerable to run risks. These are not novel vulnerabilities. As the non-bank financial institution sector continues to expand, monitoring these risks has become especially important. Turning to U.S. Treasury markets, U.S. Treasury market stress events, including the repo market stress in September of 2019 and the March 2020 dash for cash, have raised concerns about the resiliency of the U.S. Treasury markets. Last year's government securities market stress in the UK also highlighted how disruptions in the functioning of these markets can disrupt central bank plans, including the path of balance sheet reduction, even if only temporarily. Indicators of U.S. Treasury market liquidity have remained stable, and Treasury markets have continued to function, but risks remain. It will be important to watch for signs of impaired Treasury market functioning as the Federal Reserve continues to reduce its holding of Treasury securities and as Treasury auction volumes expand to meet issuance needs. Central banks and other regulatory authorities may choose to proactively use supervisory or regulatory tools to mitigate financial stability risks and vulnerabilities. Should a financial stability event occur, central banks may need to implement targeted emergency lending facilities. But turning to the balance of bank supervision and regulation, as we learned from recent bank failures in the US, responsive, efficient, and effective bank supervision is a strong mitigant for financial system risks and vulnerabilities. The failures revealed that shortcomings in bank supervision can heighten financial stability risks. To effectively support financial stability, bank supervision cannot simply rely on pinpointing compliance issues, failed processes, or rule violations. It must go further to examine a bank's critical risk exposures while prioritizing core safety and soundness issues in the context of its financial condition. If the supervisory process fails to identify and escalate critical risks, or to hold management accountable for known deficiencies, such as excess interest rate risk-taking, this raises the potential for supervisory shortcomings, including the ability to anticipate how the evolving macro-financial landscape can affect a bank's condition. As the regulatory framework becomes more complex, we must ensure that supervisors and examiners are adequately equipped to implement and maintain the highest quality of supervision. Regulatory capital requirements are simply no substitute for sound risk management and strong, effective, efficient, and transparent supervision. While some changes to the regulatory framework may be appropriate to promote financial stability, we should be careful to ensure that changes do not harm the long-term viability of banks, especially mid-sized and smaller banks. In my view, regulatory reform can pose significant financial stability risks, particularly if those changes to regulation fail to take sufficient account of the incentive effects and potential consequences. Regulatory approaches in the banking sector must also allow for innovation. Inhibiting innovation could push growth of certain products and services further into the non-bank sector, leading to much less transparency and potentially greater financial stability risk. A comprehensive regulatory approach must include enforcing existing regulation through effective supervision, expanding the regulatory perimeter, and addressing regulatory gaps. A key component of fostering financial stability is to ensure that every institution that engages in similar financial activities with similar risks is treated similarly under supervisory and regulatory authorities. Many non-bank financial institutions and products are subject to differing degrees of regulation, oversight, and monitoring. While it's important that the banking system is well regulated and supervised, it is equally important that this is the case for other types of financial institutions, products, and services. Developing effective frameworks for regulating and supervising common financial markets and products is important for ensuring the protection of consumers and for the stability of the financial system. The Federal Reserve appreciates the work that the Financial Stability Board has undertaken in this area and the strong support of my co-panelist, Governor Klasnad, has provided in his role as the chair of the FSB. So I'll turn now to central bank liquidity provision and lending facilities. Should financial stability risks materialize, central banks must be prepared to provide targeted liquidity to financial institutions during times of stress to restore market functioning and financial stability. When appropriately calibrated, these programs can help promote market functioning, but limit the Federal Reserve's overall footprint in financial markets in the longer term. In the banking system, it's also important that tools to support bank liquidity and payments, including our discount window operations and Fedwire within the Federal Reserve, are available for extended operating hours and are prepared to provide support during times of stress. We should also consider what further steps are needed to ensure that banks have access to liquidity support. In addition, we should encourage, but not mandate, the exercise of contingency funding plans and testing capabilities, requiring bank management to ensure that adequate plans are in place. In the Treasury markets, the Federal Reserve should ensure that tools like the standing repo facility are available to serve as backstops in money markets to support the effective implementation of monetary policy and smooth market functioning. Well-calibrated international swap lines and repo facilities can also be helpful in promoting both Treasury market and dollar market functioning. Of course, all central bank lending tools should serve as temporary backstops. Central banks and other agencies should ensure that regulations and market oversight foster prudent financial institution behavior and resiliency in core financial markets. Doing so can increase the ability of private markets and institutions to function during times of stress and reduce the likelihood of future market interventions by the central bank. In conclusion, many central banks are facing challenging and uncertain times as they strive to restore price stability and promote financial stability. It is essential that central banks facing high inflation bring inflation back to target. A failure to do so would only lead to greater financial stability risks through less certain and unstable economic conditions and through reduced central bank credibility. It is therefore necessary that central banks, in collaboration with other financial regulators, as appropriate, develop and use supervisory and prudential regulatory tools to promote financial stability. As these issues transcend national borders, central banks and regulatory authorities must also aim to build an international perspective that is complementary to or informed by global collaboration. This perspective has never been more important. Thank you.
Thank you very much, Michelle. We're going to unwrap some of that in Q&A, but first to you, Klaas, for your opening remarks.
So thank you very much for inviting me here. And before I delve into the substance of what I intend to say, I just want to echo Governor Bauman's comments about my thoughts also being with the victims of the earthquake, which I understand the epicenter was only some 70, 80 kilometers away from here, as well as the victims from the brutal violence that once more has erupted in the Middle East. But that being said, you've asked me to talk about, let's say, policy settings, global economy, euro area economy, and monetary policy. And sort of any comment on that, of course, has to begin with the realization that the global economy and global inflation have been swung back and forth in recent years by a series of unprecedented shocks. The impact of the shocks has, however, differed across regions. If you look in the euro area, we did also have pent-up demand following the pandemic, but that pent-up demand was less dominant than in the US, where, of course, a larger size and also an earlier implemented fiscal expansion had been a strong support of domestic demand. In turn, the euro area was more affected by the negative supply shock emanating from Russia's brutal invasion into Ukraine, and that led to an explosion of energy prices. And unlike the US, unfortunately, the euro area is not energy self-sufficient. I would say it's far from energy self-sufficient. And that, of course, led to a significant impact on imported inflation. And so you could say that while the drivers of inflation were a little bit different, with more emphasis on a positive demand shock in the US, more emphasis on the negative supply shock in the euro area, but at the same time, we were all facing high inflation at the same time. Luckily, the effects of these shocks are now gradually waning, and that should be a positive, actually, for also the forecastability of our economy, and perhaps also an improving track record to be seen over time of our economic projections. Now, in the euro area, we are currently at the juncture of weakening growth, while inflation is coming down, but it's still too high. The growth momentum is driven mostly by global factors, such as the slowdown in global trade, and of course, the monetary policy tightening by the ECB adds to this. In this environment, the manufacturing sector has already weakened for quite some time, but the slowdown is now clearly spilling over to the wider economy, including the services sector. In that sense, again, the euro area diverges a bit from the US economy, which remains resilient owing to solid domestic demand. But despite the strong monetary tightening in the euro area, and also the stagnation in the near term, the medium-term outlook for the euro area remains a bit more favorable, I would argue. The ECB projected last month that GDP growth rates will pick up again later this year, and they will converge toward potential growth in 2024 and 2025. And underlying that optimism on the economy is, of course, the strong labor market that continues to outperform expectations. Unemployment in the euro area is currently at 6.4%, and in our projections, we anticipate that rate to go up to 6.7% in 2025, the end of our projection horizon. But I think it's good to keep in mind that both numbers are well below any estimate of the natural rate of unemployment in the euro area. And the cooling of the economy that we're currently undergoing is also desirable in a way to tame inflation. In line with the economic developments, upward inflation pressures have been switching from external to domestic drivers, and services have now become the most important source of inflation persistence, and that is true both in the euro area as well as in the US. And that is, of course, because the pass-through of shocks to service prices usually takes most time. So in that sense, this inflation wave has also followed quite a predictable pattern. On this side of the Atlantic, it started with energy prices, it spilled over into goods prices, and now service prices have taken over the beta. A distinguishing feature of the current tightening cycle are the relatively strong balance sheets of euro area firms and households. And this, amongst others, follows from their responses to the negative supply shock in the past years, like, for instance, the increase that we saw in precautionary savings during the pandemic, but also the refinancing of much of the debt at much longer maturities when interest rates were still favorable. It once more underlines that financial stability is a crucial condition for monetary policy to achieve price stability. At this juncture, the generally healthy balance sheets of households and firms provide room to keep the monetary policy stance restrictive as long as is needed. And the same goes for the solid financial position of most of the internationally active banks at the core of the financial system, The financial reform agenda that we rolled out after the global financial crisis has clearly led to much more resilience in internationally active banks in the banking sector. In our part of the world, we also added some counter-cyclical buffer requirements on top of that in the last few years, in order for the banks to prepare themselves for a turn in the economy. So also from that end, so far so good, and also the financial sector that of course has to undergo a massive adjustment as a consequence of the massive change in interest rates that has taken place. But so far that adjustment has been absorbed relatively well. So all in all, we made important progress on getting inflation back to target, but we still have a long and winding road ahead of us. To ensure a timely return of inflation to target, restrictive policies will likely remain needed for some time to come. But I do believe that policy, at this moment, monetary policy is in a good place in the sense that we have a credible prospect of a return of inflation to target, let's say over the medium term, and 2025 by expectation for the euro area. But I think against the background of the unprecedented nature of the shocks that we had to live through, that would be an acceptable return to me. Of course, we are open to the realization that disinflation processes never take place in a sort of linear fashion, and there may be new shocks ahead of us. In such a case, we will remain vigilant and we will stand ready to adjust interest rates even more if the disinflation process were to stall, as the risks of prolonged wage growth and further second round effects, of course, remain. With that, I'd like to stop for the moment, and then, of course, I'm open to any further questions.
Thank you. Thank you very much, Klaas. So why don't we start with going through some of the financial stability issues. So Michel, I want to start with you. So you mentioned the non-bank financial sector, and I'm curious, what do you view as the most important vulnerabilities in that sector? Is it leverage? Is it unrealized losses? Is it something else?
Well, as I mentioned in my remarks, I think that we're seeing an increase in activity in the non-bank sector as interest rates have increased and credit tightening has continued within the banks. I think what we are seeing and we've continued to see is that there is leverage in some areas of the non-bank sector, like hedge funds, but we're also seeing additional potential risks with pension funds and insurance companies as they're participating more in some of these lending markets. So I think in combination, it's important that there's much less transparency into the activity of non-banks and that sector. But most importantly, what we need to understand, and as Klaas has really been a leader in describing, is that we need, where we have the same activity and the same risks, we need to have the same kinds of authority and oversight to understand that and to potentially regulate that, or at least oversee it.
Klaas, I'm curious on your views on this. So I was reading the FSB or the report you sent to the G20, and it makes the point that I think half of financial system assets are now non-bank financial sector, but that 90% of the leverage, I think, is with 1/3 of that sector. Is that where you think the risks are, or is it somewhere else?
Yeah, at least it's one place where I think the risks are. It's good to keep in mind that, of course, the non-bank sector is entirely different from the bank sector. It's much more heterogeneous, and that's why it's also much more difficult, even, I would say, to properly regulate and supervise. But if you think about this NBFI world, the sort of vulnerabilities are much less about, let's say, classical solvency, etc., but much more about liquidity mismatches in the open-ended fund world, in the money market funds world. Lack of preparedness for margin calls. That is also clearly something where I believe that the infrastructure needs to be strengthened. And then indeed, the third vulnerability that I'd like to point out is that in all the episodes of NBFI stress that we've seen, be it the dash for cash, be it the commodity traders in February 22, be it the Archegos case, be it the UK LDI episode. In all these sort of episodes, there was a form of hidden leverage that we had not spotted before. And that is, I think, still uncomfortable, that each time there is a pocket of leverage in the system where we, after the fact, are asking ourselves, why didn't we spot it, and why didn't we sort of see this coming? So the main item on our FSB/NBFI agenda is the work on leverage. That is now, has to take front and center, and we have to take a much deeper dive into where sort of these pockets of leverage are. Well, one finding, I already reported to the G20 that you referred to, but that is, of course, is a very high-level finding. We really need to dig a lot deeper to get sort of our arms around this issue.
Okay, and then Michelle, I want to come back on commercial real estate. So you mentioned some of the risks associated with that, so very concentrated portfolios for certain banks, losses on CMBS, which I guess affects securities portfolios. But what is the macro relevance here? Should we think of commercial real estate risk as being mainly a financial stability issue that obviously needs to be analyzed and sort of ring-fenced? Or do you think of commercial real estate risk as something that could actually have macroeconomic implications in terms of slowing activity and ultimately having some impact also on monetary policy?
So as I mentioned, again, in my remarks, what we're seeing as we're looking at these different lending portfolios and loan portfolios with our with financial institutions in particular, when we're stress testing for these potential conditions, as we did with the stress test this year, and all of our banks did perform adequately and pass that test. What I think as we're looking at the totality of the circumstances with potential stress in the commercial real estate market is that even if there were some significant downturn and erosion of values, that it would likely be a smaller impact than it has been in the past, since loan-to-value ratios have improved significantly. Banks have changed their lending practices dramatically since the 2008-2009 financial crisis. So we're seeing banks in a much stronger position with these loans for commercial real estate. And as I mentioned too, it's a geographic as well as a sector-based potential risk. And as we see some areas where, or some cities where we might see owners of these buildings or borrowers giving back the keys to some of these larger properties, it's really targeted in where it's being, where the stress is being located. In some cities that have yet to return fully to in-office, so there's less traffic in order to facilitate more occupancy in these buildings.
Klaas, how do you think about it?
Yeah, I think, I mean, the commercial real estate sector is, of course, suffering from a confluence of cyclical and structural risks. On the cyclical side, it's one of the sectors that is most interest rate sensitive. That has always been the case. So in that sense, there's nothing new under the sun, but the steep increase in interest rate has, of course, led to valuation losses in the sector. But on top of that, I think there are a couple of structural developments. More and more emphasis on online shopping, working from home, which I think also structurally reduces the demand for office space, for retail outlets, and what have you. And then thirdly, I would also mention the drive toward sustainability and the energy transition also puts sort of higher requirements on commercial real estate to fulfill in order to be licensed to operate. So that also, I think, increases costs on the sector. So there are risks out there, and there have also been losses. I mean, the average price decline of commercial real estate, for instance, in the Netherlands has been like 13% already since its peak, and I believe that the numbers elsewhere in the euro area are even slightly higher. But then, of course, the big question is, where does that risk reside? And for instance, in the country that I know the best, most of these commercial real estate risks are in pretty closed-end investment funds where the investors cannot sort of redeem at their own, let's say, preference all the time, where the redemption terms are quite sort of synchronized with the illiquidity of the investment. Now, as long as that is the case, then I think the losses can be well absorbed, etc. banks, I think, have learned a bit of a lesson from the episode 15 years ago. Banks are less heavy involved, at least on this side of the Atlantic, in commercial real estate than they were in the past. So yes, there will be losses, for sure. There are risks out there. But at the moment, I feel that the risks are in a better place than they were in the previous downturn of the commercial real estate cycle.
All right, so let's turn to a little bit more towards monetary policy and how the economy is responding to that. So Klaas, I'll come to you first on just the notion that there might be a lower level of interest sensitivity in the economy now. The evidence on that looks mixed at some level for the Eurozone. Your pricing power, profitability looks stronger actually than in the US. The labor market looks just as tight, or maybe even on some metrics slightly tighter. How are you thinking, and then we've talked about commercial real estate, which clearly has or is responding, right? So how do you think about that narrative of, is it really the case that the economy has become less interest sensitive?
Well, I very much understand the question. I think it's simply too early to tell, because a lot of the tightening effects, I think a lot of the trend has been, I mean, you could easily think that transmission so far has not been very strong. I do think in the coming months we will see a strong decline in inflation, by the way, simply also because there are some base effects. But the reasons behind a possibly more resilient activity to the higher interest rates, of course, has to do with what I also mentioned in my opening remarks, the strong balance sheet of households and firms, which have had the time to prepare themselves, lengthening of maturities of outstanding debt, so that the higher refinance cost will only come with a delay, and also the strong labor market. As long as there is not a real prospect of strong unemployment, then typically the declines in real estate prices, in residential real estate prices at least, will be contained. And in many of our economies, residential real estate is also an important transmission of monetary policy. So yes, there are reasons why so far the economy has only moderately cooled and stagnated. I would say we're not yet into recessionary territory. But a word of caution: I think a lot of the transmission will still be in the pipeline.
And Michel, so another aspect of this resiliency, and obviously the US is showing a lot of resilience on many metrics, but another aspect of it is if you look at the lending surveys, they clearly look recessionary. But then you look at the loan growth, it doesn't look so bad, right? So what do you make of that? How do we reconcile those two?
Well, I think what we have seen over the past year or so, we do our annual or our quarterly SLOOS, which is the Senior Loan Officer Opinion Survey, about how they see lending conditions evolving or moving forward. And we've been hearing since the fall of 2022 or even the summer of 2022 that their expectations were that credit conditions were tightening. And we've seen financial conditions tightening, I think, across the board. So what we're seeing is exactly what was anticipated from last summer. As interest rates have increased, lending conditions have tightened, funding costs have increased, and that leads to a more cautious extension of credit. But what we haven't seen is a sharp tightening in lending activity that we would have expected were there something to be concerned about. So we are seeing the continuation of extensions of credit. We are seeing continued activity in the residential real estate sector, albeit slower, but borrowers are more price sensitive. We're also seeing, a great deal more cash transactions in the residential real estate market, but we're not seeing the significant contraction that I think that we would have expected to see were we to be concerned about conditions at this point. I think it's exactly as we would expect. As financial conditions have tightened, the policy rate has increased, and there's more activity, of course, in the non-bank lending sector than in the regulated bank sector at this point, simply because of that tightening and different costs of funding structures.
Okay. And Klaas, so given the resiliency in both the U.S. and the Eurozone, how do you really know that you've done enough here? Because right, so how do you have a forecast and you express some confidence in if no other shocks happen that you could your landing zone is pretty close to the target. But what are you looking for to validate that forecast? Like what are sort of your markers that you're looking at to to show that you're on the right track?
We will know whether we've done enough when we will meet here again in 2 years from now. And we will observe that inflation is completely flat and stable at 2.0%. No, I mean, of course, in order to judge whether we've done enough, we have to continuously update our projections on how we think the economy and inflation will develop in the next, let's say, 2 years or so. At the moment, I'm getting a little bit more confidence in our projections again, because these unprecedented shocks that made sort of our models a bit obsolete and the output of our models less reliable than would normally be the case, these shocks are waning. Now, in our projections at this moment, we have a disinflation trajectory ahead of us that takes us back to 2% in the course of 2025, towards the end of 2025 rather than the beginning. And I wouldn't mind if that shifted forward still a little bit in time, but I think that is the sort of credible prospect that I talked about. And this time I also think that there is value in these projections. I mean, a year ago I was much less reliant on our own projections than I am today. But of course, we have to monitor. There will be new shocks, and there are a couple of critical assumptions underlying this disinflation trajectory, not the least, of course, under the behavior of wages. Wages and the capacity of profit margins to absorb the wage pressures that are still there. So an important marker, I think, for us will be the development in wages, since also the main source of inflation is now services inflation. And if there were to be a material deviation in the behavior of wages from the development that underlies our projections, then of course we would have to respond to that. So then we would not have been doing enough. But at the moment, I think, for the moment, I'm comfortable with the current policy settings as they are, but we will remain vigilant.
Great. Let's open it up to the audience. So please raise your hand if you have a question. We'll take a few questions. I see Andreas Billmeyer. We got the second one, third one. Do I have a microphone coming across? Or do they just have to speak very loudly? There we go. There's a microphone. Okay, Andreas, you first.
Is this power on?
Yeah.
Oh, there you go. Okay. So just on the last point to Klaas Knot. So the standard way of thinking about the link between wages and underlying inflation is that wages is 3 years, underlying inflation at 12 months hence, roughly, right? Now, the wage forecast that the ECB shows is one where if you wanted to be at core at 2 in 2025, the wages then would have to be at 3 a year earlier, 24. Turns out wages in 24 are at 4.5. So there is still a chance you can make that work, that you are in core inflation, headline inflation at 2 in 25, but it might not be an equilibrium in the way of 3 and 2. Can you speak a little bit to that? How do you think about that wage transmission, how that works out in these circumstances that it might...
Yeah.
Okay, let's take a few more questions and then we'll answer them all in turn. So yeah, go ahead, right next to you.
Thank you, Francesco Gazzarelli from Heisner Capital. A question is different from macro. It goes back to your remarks about financial stability. And as the saying goes, we always fight the last war. So it's great that both of you have emphasized shadow banking, which I currently reside in. The question is around, let's accept the fact that we have opacity. Even us within the sector do a lot of risk management, but we don't know if everybody has the same trades, and we can always only rely on history for stress testing. So the question is, for you as policymakers, if we take the two extremes, what can you do if you get more uncomfortable about what is going on? Can you try to regulate shadow banking via what you already regulate? I'm thinking here prime brokerage, for instance. Can you put margin calls? Can you try to operate through those channels? And on the other extreme, let's say an accident does happen, which feeds on itself. What can you do at the other end? As you talked about instruments that are available, but from what we know, they're available to banks rather than the shadow banks. Thanks.
Okay, and sorry, just one question over there, and then Christian, and then we'll do the answers. So just at the back over there. Sorry, at the back over there. Yep. Great.
You hear me?
Yes.
Oh, yeah, now it's on. Okay. Yeah, I just wanted to point out in the current Wall Street Journal online, they're saying that the bond market, the tightening bond market, is maybe taking over from the Fed and making it unnecessary for the Fed to continue raising rates. So that's the market speaking. In effect, that's that's really an effect of Fed action already. So it's having its effect in the bond market, and maybe, you know, it's as events evolve, you know, the inflation will abate. Thank you.
Great, and very quickly, Christian, and then we'll go to...
I have a financial stability question for Michelle. One of the more controversial tools that the Fed has set up is the reverse repo facility for money market funds. No? So many people argue that by doing this, you introduce a level of volatility on the liability side of commercial banks by giving non-banks access to the central bank deposit facility. And also you sort of create an open deposit system, no? Where deposits can actually leave the commercial banking system and go to the central bank and are no longer available for the commercial banks. While in Europe we have a closed deposit system. We don't give access, we don't give non-banks access to the deposit window of the central bank. So do you have any second thoughts on that facility? Do you think it makes sense to keep it after all these episodes we've seen earlier this year?
Great, thank you. So I don't know who wants to start. Klaas, do you want to start?
Well, I can first take the question on wages, where I fundamentally agree that the equilibrium of a sort of lasting convergence toward a 2% inflation target requires 2% plus that little bit of productivity growth that we have left in the euro area. That should, of course, also increase, I think, which is one of the longer-term challenges. But okay, that is not in the hands of the central bankers. So 3% wages, let's say, for the moment, and 2% inflation are the equilibrium. And you're correctly pointing out we're not at that equilibrium according to our projections in 2024, because we still have higher wage growth than 3% in our projections. Now, the reason why we still think that that is compatible with a return to 2% inflation in 2025 has to do with profit margins. So we do believe that particularly 2022 has been quite an abundant year for profit margins. I think the stars were perfectly aligned for corporate profitability in 2022. Of course, the situation is becoming a bit less favorable at this moment, but we still believe that corporate profit margins have room to absorb higher wages. This is simply a delayed effect of the loss in purchasing power that sort of European citizens suffered and now trying to recoup through contractual wage agreements. That process has to take its dynamics, that has to crystallize, has to work its way through the system. Had the moment that would lead to a conclusion that high wage growth would also extend beyond 2024, that would be one of the markers where we would have to conclude, okay, in that case, there's still too strong an upside risk to this baseline that I described a few times before. But if it only sort of relates to 2024, we believe that profit margins are there to absorb it.
Well, thank you. I'll take the question about the Wall Street Journal article and the rising bond yields first. I think what we know is that financial market conditions have certainly tightened. That's not even a question. I think the important thing to note there is that allows us a little bit of patience, that we can continue to watch as economic conditions and financial conditions continue to evolve. But it's important to note that that's just one indicator of the things that we're watching, and while it's an important one, there are many others that play into the importance of the information and how we weigh that information as we're considering our decision making. In my mind, we still are a long way from 2% for inflation, and it's important that we identify a path or are continuing on a path that will allow us to reach 2% inflation in a sustainable and timely way. So I think I think I'll continue to watch inflation as financial conditions continue to evolve and develop, and that gives us a little bit more of an opportunity as a committee to weigh the data as it's coming in, and we're definitely data dependent in the path going forward. So, it's another factor that we will consider. But if we don't find ourselves, making a dent, or if we see inflation increasing again, then certainly we need to be able to position ourselves to be ready to increase rates if that's a necessary action.
And then we had a few, I think, financial stability.
The leaky floor.
The leaky floor.
Do you want to address one of those?
No, I think that was a question
Oh,
to you, right,
okay.
on the
So
reverse repo.
there was a question about non-banks, and remind me the rest of your question.
Non-bank access to the deposit.
And then there was another one too.
How can you, what instruments do you have if there is an incident in non-banks?
So we have a number of past facilities that we've created in order to try to address emergencies as they exist. And I know you would prefer that perhaps we did not do things like the standing repo facility or other emergency facilities that would result in access to liquidity for non-banks. But I think that what we've seen is that that's addressed conditions in the past that have stemmed emergency type flows or situations that have been a risk to financial stability and market functioning going forward. So I don't know at this point. We're always continuing to review our facilities and their functionality and whether they're accomplishing the goals that we have for their creation, and I'll certainly consider your feedback as we're thinking about that going forward. Thank you for your questions.
I just want to add what is hopefully the obvious. I mean, the purpose of the FSB undertaking such a huge work program on NBFI is to create more resilience within the NBFI universe, but also with a second purpose to reduce the likelihood of the central banks having continuously to step in. So that's a very clear objective also of the work on NBFI. It's not a good place to be in when in audiences like this we openly speculate about what will the Fed do, what will the ECB do, what will the central bank do to bail out NBFI turbulences. NBFI turbulences should be dealt with by sufficient loss absorbency in the NBFI sector.
Great. Thank you so much, Klaas. Thank you, Michelle. We are out of time, and thank you all for attending. Please, a warm thank you for both the panelists.
Ladies and gentlemen, we will now take a break before reconvening for our IMF session. We invite you all to a coffee break in the foyer behind the conference room.